Good morning everyone. I am Mamta Sharma, Assistant Professor, Chandigarh Business School of Administration. I'm here to teach you the subject of financial management. See, we have learned so many subjects in commerce and management courses, and among one of them is financial management. You guys have thought about that why financial management, because we have studied already accounting, but how it is linked with the financial management. See, accounting is just the recording the transactions. Accounting is just analyzing the transaction. But under financial management, there are two words which are combined with each other. One is financial and another is management. From financial, we could judge it is related to finance. Finance means funds. So, if you talk about funds, the funds are the blood circulation of any of the company. For example, if blood is required for every human being to go here and there to do all the tasks, similarly funds are the blood for the organization, because without funds we cannot do anything, right? So here we are going to introduce first what finance is. Finance is the art and science of managing money, right? We say that finance is art. Why art? Because every person is having their own art, own things to how to manage the money. So that is why we can call finance as an art. And if you talk about science, so when you are going to invest some of the money, there will be a logical things behind that, right? So if there is a cause and effect relationship between anything, so it is called science. So if we are talking about finance as a science, so we could say that if we are investing some of the money to something, right, so what would be the effect of that particular thing? For example, you are investing 100 rupees into a bank, or you can say you have invested some money into a shares. After, what would be the effect of that particular money after a year, after a month, after a couple of months, right? So that is why we could say that finance is managing money, right? And it is an art as well as science. So, and what is management? Management means planning, organizing, classifying, right, staffing and directing, right? All the things comes under management. So combinedly, financial management means how you could manage the money, how could you plan the money, how could you organize the money, how could you directing that money, how could you acquire the money, how could you invest the money, how could you finance the money. These all things comes under the financial management. If we are talking about a typical definition of financial management, then it would say that it concerns the acquisition of money. It means from where you can acquire the money for your company. Then it is what financing the money, what are the different sources of money, how you are investing your money into different sources. That could be a long-term sources, that could be a short-term sources, and the last one, management of assets with some overall goal in your mind, right? What are the overall goal in financial management are profit maximization, and second one is wealth maximization, right? So here we talk about financial management is planning, organizing, directing, controlling the financial activities, and like procurement of the fund, utilization of the funds in the enterprising. It means all the applying general management concept into the finance thing, right? So financial management is the managerial activity in which you could focus on three things. One is acquiring the funds, right? What is acquiring the fund? Acquiring funds means from where you can acquire your funds. You are into a business, right? So you wanted, no business cannot run without money. So what are the different sources from which you can get money, right? It could be a long-term funds, it could be a short-term funds, right? Long-term funds should be a FDs, your shares, your debentures, your bonds, right? Your reserves, right? Your flowing back profits also. And the short-term funds like credit, right, creditors, right, your debtors, right, your bank deposits, your cash in hand, your working capital, all things comes under the short term fund. So financial management is basically how you acquire the funds, right. Acquiring means which are the sources from where you can get maximum utilization of that particular funds, because I am using the term management over here, right. So management means best utilization of the activities, best utilization of the funds, really. So this is how we could say that what is acquisition of the fund. Second one is comes under financial management is investing the funds, yeah, investment options, right. So in financial management we do have two type of sources in which we could invest. One is long term sources and another one is short term sources. Long term sources like plant and machinery, whether what the acquired fund should be invested into the long term sources or the short term sources, right. Long term sources can be like plant and machinery, like building, like your stock in each and etc., right. So this is the decision taken by the financial manager. So in which sources they are going to invest that particular fund, that could be acquired from various sources. That would be the combination of different sources like shares, debentures, owner's own money, bank deposit, your cash in hand, and all the sources which you are from which you are acquired the money, right. So second thing is investing the money. The second option for investing is short term sources. The short term sources are like you have to invest into the stock, you have to invest into the salaries, you have to pay every day to day expenses also, right. So these are called short term. हम in short इसको हम एक नाम देते हैं, that is working capital, right. And long term, if we are investing the money into long term sources, it is called capital budgeting. That we will discuss in the next few chapters, right. So financial management is first is investing, acquisition of funds, second is investing the funds, and third one is division of the funds, like what you get from the investment, that is your return, right. So the return in where you are going to utilize that particular return, whether you are distributed that returns to the shareholders as their profits, as their dividends, as their returns, or you are keeping something for your own self, right. So there are two options over there. One, you can distribute your profits among the shareholder, debenture holders, bond holders, right. And another one is you are keeping your funds as a reserve, so that in future if any circumstances has happened, that funds could be used into that manner also. So basically there are three things under financial management is acquisition of the fund, investment of the fund, and division of the funds. Now financial management is what? It is basically again managerial activity. Managerial activity in which we could plan the money, we could control the money. In planning the money, we could take, there are decisions, where do you get money from? Where do we allocate that money? And how much to distribute and how much we have to retain. So these are the three important decisions that we have already discussed. These are the three important decisions under financial management that has to be taken by the financial manager, right. So basically all these three decisions are covered under planning, organizing, controlling, directing, and monitoring the monetary resources of the organization. These are the decisions which are very important for every organization and every enterprise, right. Because without funds we cannot run the organization. So what kind of decision a financial manager take, right. So the function of raising funds, investing them and in assets, and distributed return earned from the assets of the shareholders are respectively known as financial decision or capital mix decision, right. So financing decisions are like with what kind of sources are available into the market. If I am using the shares to finance my company, to run my company, so whether it is the best decision for my company or not, right. So If I'm using bond, how much return, how much interest I have to pay. If I'm using the share, how much dividend I have to pay, right? So these all things has been comes under the financial decision. Second one is investment decision or long-term asset mix decision. It means that in which assets we are going to invest our money, right? So what kind of assets are there? There are fixed assets. Normally we use fixed assets as a long-term assets, right? And there are short-term assets also. That could be a working capital also. The long-term assets are very important for the organization because it gives the benefits to years by years, right? And after many years the things has to be obsolete, right? So which technology we are going to use into our company, which kind of machineries we are going in which we are investing our money. There are so many things that comes under the long term asset mix decision, right? So it is a very important decision for a financial management for the investment because it include a huge amount, right? It is not an easy task to acquire money from the shareholders, from the bonds, from the banks, from the loans, long-term loans. But the investment decision is more critical because we have to judge whether these decision gives us return and how much return they will give us, right? So the finance manager have to took this decision regarding investment of the money, investment of the funds, right? And another thing comes under investment decision is short-term assets. Like we are in organization, if machineries are required, if plant is required, if furniture is required, then what other things are required? That is daily expenses. We have to invest into the stock also. We have to invest into the day-to-day operations also. We have to invest into the salaries of the employees. We have to invest into the wages of the employees. So all these kind of decisions, all this kind of investments comes under the short-term assets also, right? Third thing is dividend decision or profit allocation decision, which is very important. From these two points, what we get, that is the return. Like we are investing our money into some project and how much we will get back from that particular project. If it is a profit, then how to use that profit. If it is a loss, then how to minimize that loss. Like we have to use whatever the return we get from that investment decision, we have to utilize it properly. We have to utilize it in the maximum efficiency way, right? So dividend decision or profit allocation decision is also a very important task for a finance manager. Because under dividend decision, every organization requires some of the profit, some of the returns for their own expenses, for their own developments. So they have to keep some of the funds as their reserve, and they have to keep some of the funds to their shareholder from where they get the money. Like they could be a shareholder, they could be a bankers, they could be a debenture holder, they could be a bond holder. So everyone who is going to invest their money into our organization, they are expecting kind of returns also. So this is very important. So these are the three major decisions that a finance manager have to take under financial management. Okay, next we are talking about investment decision. It is the most important of the three decisions. Where do we allocate fund, right? There are three type of question that has been arise under this criteria. Why? What is the optimal firm size? What specific asset should be acquired? What assets should be reduced or eliminated, right? So what is the optimal firm size? Optimum firm size means how much assets are required to a firm so that it will give us a maximum return. How much amount is to be invested into that particular assets that will give us a maximum profits, optimal profits, that will increase our wealth. Also, there are two objectives of the financial management. One is profit maximization and another is wealth maximization. So if we are taking the investment decision under financial management, we have to keep that things into our mind that with the help of this decision, I could, or a finance manager could, optimize or maximize their wealth or maximize their profits, right? What specific asset should be acquired? Like what kind of, like if machinery is required and I have several types of machinery, which machinery would be the best machinery for my organization that could not be obsolete in a coming 10 years, 20 years or 30 years, right? Because it would in machinery we have to spend huge money. Then what assets should be reduced or eliminated? If my organization is required if my organization is required 3 types of machinery and in market there are 6 types of machinery, so can my work could be completed into 2 machineries or 1 machineries if it is possible. So in which assets I could be added, in which assets I could be reduced by money. So these are the 3 important types of decision, because from this investment decision we would calculate our returns, right? So that things comes under the capital budgeting. We do have several types of project A, B, C, D, and every project have their own tenure. We use NPV, IRR methods so that we could analyze which project is giving us a better returns. So this is one of the investment decision we could take under a financial management. Second one is financing decision. Financing decision, it determines how the assets that could be shown right hand sides of the balance sheet will be financed. That is left hand side of the balance sheet means how much capital you have to utilize to invest into different assets. Where do you get money from? What is the best type of financing? For example, every source of finance has their own benefits, their own drawbacks. Like if you are taking money from the shareholders, so they are having their own benefit. For example, if I'm talking about shareholders, if the organization is getting profits, right, so the company will give the returns to that particular shareholders. But if the company is not having a sufficient amount of profit, so they could lag the profits, or they are asking, we do not have any profits by this year, so we could not make any kind of things, right? Like you guys have searched about the shareholder prices increases and decreases. If the company is getting profit, your share value has been increased. If the company is not getting profit, the share values have been decreased. So this could be the benefit of the shareholder fund. So there are several benefits of each and every fund, right? There are interest. You can see that on dividends we have to pay fixed amount of interest in advance. We have in advance, right? So if the company is organized, if the organization is having profits or losses, so that would not be the decision of the organization whether they are providing interest to the debenture holders or not. If the organization is having profits, they have to pay the interest. If the organization is not having the profit, then they obviously they have to pay the interest to the debenture holder. Sorry. Then what is the best financial mix? So it is not good to put all the eggs into a one basket. Like we cannot raise funds from the one source. We have to do some mixture, that is portfolio. Like few amount we could raise by the shareholder, few amount we could raise by the debenture holder, few amount we could raise from the banks also. So what could be the capital structure? Whether shares should be increased, whether debenture should be increased, what is the quantity of each finance source, right? And how will the funds be physically acquired? Like kis tarah se, like how what are the different way that we could acquire the funds? Whether we are getting the checks, whether we are giving the cash, all the things are very important under the financial decision. So from the investing decision we could just judge in what is the right amount we are required to invest into. And in financing decision, we judge that what are the best sources to acquire that kind of funds. And the third one is dividend decision, right? From the first decision, that is investment decision, we analyze how much funds are required. Then we analyze under financing decision that what are the best sources of finance. And the third one is dividend sources. If we are investing that sources into that in the first decision, then how much we get in return. Like Under dividend decision, the return has been measured and also how much to distribute and what to retain. A firm, an organization, an enterprise should distribute all its profits or retain them or distribute a portion of that particular that profits and retain the balance. These could be the decisions comes under dividend decision. The proportion of profit distributed as dividend is called dividend payout ratio, and the retained portion of the profit is known as retention ratio. These are very important chapters under financial management. So we will discuss these ratios, dividend payout ratio, how much profits are to be distributed, right, among the total profit, what percentage of profits you are going to distribute from the actual profits, and how much, and the retention ratio means how much profit, how much part of the profits, how much amount of the profit you are retaining with yourself, right. And then the optimum dividend policy is one that maximizes the market value of the firm's share. That is the second objective of financial management. It could be wealth maximization. So if you are deciding about the dividend policy of the organization, so that will increase the wealth of the organization. That should be the dividend policy for the organization. Okay. Now comes to financial manager. We have discussed all about financial management. What financial management is, what is the things a finance manager do. But basically all the things, all the decisions has been taken by a person who's called financial manager. So it is very important to discuss the role of financial manager. A financial manager is the person who is responsible all type of finance decision, all type of investment decision, and all types of dividend decision. So the main function of the finance managers could be the financial forecasting and planning. The first thing is investment decision. How much money an organization is required to carry on their functions, how much money the organization is required for the smooth functioning for the organization, from where the funds could be acquired, at where funds could be allocated, what would be the policies for the dividends, and how he should have the understanding of capital markets, and they should have maintaining the proper liquidity into their organization. So basically objective comes on the objective. There are two major objectives, that is profit maximization and another one is wealth maximization, because every business who is investing huge amount of funds, why they are investing their money? Because they wanted to get returns from that particular business, and here the primary objective is profit maximization and the secondary objective is wealth maximization. But now in the modern approaches we main focus on the wealth maximization, because it increases the firm's value also, it increases the shares value of the organization also. So that is why we are more focusing upon the wealth maximization approach. Traditionally we focus on the profit maximization approach also. Then what profit maximization is? Maximizing a firm's earning, right? To increase the profits, to increase the returns from the profit, maximize the rupee income of the firm. Like how could we increase the efficiency, how could we increase the profit? If we utilization the resources in an efficient way, if we are appropriately guess the requirement of the funds and measures all the firm's performance, on the basis of that we could find out how many resources and what are the best resources for my organization. I could increase the profits of the organization. And the last one is serves interest of the society also. If my organization has a good image in among the society people, then it will also good for the profits also. Then objections, there are certain objections under profit maximization. That is why that wealth maximization objectives comes out. That is, the profit maximization could be a vague thing also, because I don't know if I am investing a less amount of money. So it could not be a good approach for the profit maximization. The timings of the return, the present value of it does not include the present value of the money, because the present value of the money is larger as compared to the money we earned in the future. It ignores the risk, all the risk we are facing during the operations of the organization, and new business profit maximization is not, necessary in the initial stages, because it is very much unrealistic, it is very much difficult to get the profits in the initial stages, and it is inappropriate, obviously inappropriate things. Then what are the objectives of wealth maximization? Means the second objective that we are using under financial management. So wealth maximization means to maximize the shareholder wealth, right? It means the value, net present value, of course, the action to the shareholder. It improves the present value of the shareholder's wealth. So net present value, what is net present value? It is the difference between the present value of the benefits and the present value of the cost. How much you are earning presently and how much you are spending presently. The net present value is the difference between these two terms. A financial action that has positive NPV creates wealth for the shareholder and desirable profits, and vice versa. So there are various features, that is why we are choosing wealth maximization as a primary objective for the financial management, because it incorporates the time value of the money. It focuses on the time of the return you are getting. It measures the benefit in terms of the cash flow and avoid the ambiguity associated with the accounting profits. Right? It takes care also the risk thing. Whatever the negligence that has been withdrawn in the profit maximization objective, that has been cured under the wealth maximization decisions. So fundamental objective is the maximize the market value of the firm and the maximize the market value of the shares of the shareholder, so that the image of the company, image of the organization could be better in terms of profits. Besides that, there are several other objectives of financial management. It means to provide the supply of the funds at appropriate time and in adequate manner. It provides a fair rate of returns to the suppliers of capital. It could be shareholder, dividend holders, debenture holder, bond holders. It ensures the effective utilization of the funds that has been acquired by the financial manager from the different sources of the funds. It also generate and build a sufficient surplus and division of profit in a maximum utilization way to minimize the cost of capital. Right, there are various security. It also ensure the major objective is also ensure to get portfolio for the organization, so it could the cost of the organization is less and the profit of the organization could be more. And it coordinate another and the last objective for financial management is to coordinate all the activities starting from investing to dividend decision, so that all the activities gives the maximum returns to the organization. These are the functions. We could discuss the functions of financial management. Similarly, as the role of financial management, it estimates the requirement, how much money is required. It also determines the capital structure, that is how much amount of money generated from the different sources also. It could also be, helpful to get the choices of the sources of finance, how to invest into the funds, how could manage the cash into the organization, how could do if we are having surplus and we are having profit, so how could dispose that surplus, and and every finance control how much money is going to be spent into different assets or different short term or long term asset, how to manage that particular money into the organization.